Hello everyone, happy Wednesday, super easy family. I'm making this video again because last night it didn't record. I think my super loving iPad kind of kicked us off when I switched screens. So this video is going to kind of tell you how I use my compounding sheet, why it's important, and some things you need to know. So having said that, you guys already know how we kind of find our trades. We either use the swing trade method in terms of the 4 hour, confirmed on the 1 hour, using the super easy triple arrow system, as well as whatever oscillators suit your eyes best. We also can kind of play off the Stairmaster and the support and resistance, keeping it super simple, just going for a certain amount of pips. And then the third way is that we use that my little SARS kind of 10 pip strategy in terms of scalping, and we would do that from our phone on the 15-minute chart, and that's just going for a handful of pips. So if you're part of the group, you know how we find our trades. But what I wanted to do was go ahead and show you how to manage them. So let's make sure it doesn't kick us off. Bear with me. I'm gonna minimize this. There we go. Got into my Zoom. Let's see. And it's working on it. 1 second, and the recording did not stop. So yay. The first thing I'll tell you is that every one of these worksheets is based off of the USD pairs that trade at $10 per lot. So at the end of the day, the first thing you're going to want to do is use a pip calculator. There's a free app called Stenu, S-T-N-U, on Apple and Android. There's my FX book, which is my preference because it's a lot more in-depth. And I'm sure there's about 1,000 other pip calculators that you can use. But no one should decide your lot size but yourself, because you need to know what your leverage is, what your account size is, what your tolerance for risk is, as well as what pair you're trading. So some pairs trade less than $10 per lot, some trade more. All US pairs trade at $10 per lot. So having that disclaimer out there, you're still going to want to make sure you use a pip calculator. But this is a kind of a really good starting point to figure out how to compound your account. And the biggest advantage to using a trading plan or a trading journal or a compounding sheet such as this is because not only will it help you hit just supernatural levels of income in short amounts of time, but it will also keep you from overtrading. It'll tell you when to stop trading. And I think overtrading is one of the reasons why a lot of people end up blowing their accounts. So having said that, let's go ahead and get started. I did have this at per day. I keep fixing that. I don't know why it's not fixing. Hold on. We don't want it to say that. We want it to say per day. The first thing I'll tell you is I don't recommend you guys trading per day, because that puts you into a really bad habit in terms of on days that you didn't hit your goal, which will happen. On days that you didn't hit whatever your pip goal was, you end up revenge trading. You end up kind of fishing, and your eyes kind of trick you into seeing stuff that maybe isn't there, just so you can get those pips and hit your goal for the day. So I would recommend sticking with the per trade kind of equation, as well as a weekly growth kind of equation. And so first we're going to start with the per trade. Let's see. As you guys can see, this account is starting with $150. The percentage of growth per trade is 20%, which is very, very doable if you're finding the right trades. I mean, you only need a handful of good trades per week, whether you're going for 20 or 30 pips or whether you're going for the swing trades. You don't need to be in 50 trades a week. That's really poor time management, money management, and it's definitely the path to disaster. So anyhow, so just kind of sticking with the numbers that we have on here, this little risk management calculator is, again, very generic. It's just based off of the US dollar pairs, but it's enough to give you kind of a roundabout idea. You should also not be risking more than 10% of your account per trade, and that's if you have a really high level of accuracy. So if your accuracy is still pretty low, I wouldn't risk more than 3 to 5% per trade, because that's a high level of risk. As your accuracy increases, a lot of us can definitely do more than 10%, but again, that's very risky. You will blow your account very quickly. So you also have to know your leverage in terms of knowing whether or not your account can handle a bigger lot size or not. It's very, very individual experience in terms of your leverage, your broker, swap fees, commissions, what particular pair you're trading, account balance, and about a multitude of other factors. So having said that, this kind of gives you an idea. If your stop loss was 20 pips, your risk per position was 10%, you'd be risking $15, and the max lot size you could do is a 0.08. So this is just kind of here just to kind of give you a guide. Again, I still recommend using a pip calculator. because there's a lot more information in that and you'll be a lot more accurate. So let's take a look at it. As you guys can see, if your pip trade, and I'm going to change that too because I don't want anybody per trade is 20 pips, and that's how many you're going for on that trade. The lot size you would be using is a 0.15. Most $150 accounts can handle that lot size provided you have enough leverage. You cannot use that lot size if you have a 50-to-1 leverage. You will blow your account. I think the minimum you would need is like a 500-to-1. But if you were going for slightly more, your lot size is obviously smaller. So if you were trading like a GBP pair, you guys already know that I use the average daily range to find my take profit, at least my initial take profit. And then, of course, I let some run in terms of a swing trade. But to find my initial take profit, I use that average daily range, or I'm going for a set 20 pips-ish on non-GBP pairs. So, or I'm going for a 30 to 40 pip goal on GBP pairs. So at the end of the day, or at the end of that trade, you should have gained $30. And you guys can see as you go down, the lot size increases. And essentially the idea would be when you have found, give or take, 50 good trades, whoopsie, here we go. When you have found 50 good trades, you would literally have hit over 7 figures. And I'm not the only one who's been able to accomplish insane amounts of money just using a compounding sheet. So yes, some of these trades will be losing trades. So when you go to enter it in, you would enter in, let's say you had $30 on this day, and the following day, your stop loss got hit and you lost 20. So in order for this worksheet to calculate it accurately, all you need to do is hit negative 20, right? And then the following day, when you go to pick your lot size, you're going to pick your lot size based off of your actual balance, not your target balance. So if your actual balance now is give or take 180, you're going to be looking at the lot size for the following day. You're not going to be looking at this lot size without blowing your account, just to give you an idea. And there's some other worksheets that kind of do that a little better, but they're way more complicated. So I don't personally prefer them. This kind of still keeps it simple because, as you know, some days, if you let that trade run, you're going to come out way over. So it kind of, the losses kind of come out in the wash. And with discipline, this is all super, super possible. So that is how I do it in one account. I do withdrawal every week or two whenever it hits a certain balance. So in that account, I let it get to $5,000 or $10,000, and then I leave $2,000 in there, and I just take the rest. And that's kind of how I function in that account. It works very well for me. In terms of my bigger accounts that I want to grow to bigger numbers, and that's why we have this called the Super Easy $1 Million Trader, is because I set this up in 4 different ways so you guys can get an idea without having to plug in your own numbers. And the idea was, if you're starting with more money, you can use a smaller weekly percentage, and this is based off of a weekly pip goal. So if you did one of my strategies, which is the find 4 trades, and then you stack them with the 22, 44, and 77 take profits, or you can just stack them twice, which is much easier to manage for most newbies. But the idea is you find 4 to 5 trades, you have 1 take profit and 1 runner. To get 500 pips a week is beyond doable. I know some of us are averaging well over 1,000. Some weeks I can average 2,000 and 3,000 without even using stuff like US30 or crypto. So very, very easy to do. Having said that, this would obviously be your lot size. This is your daily goal. More accurately, this is your weekly goal. So at the end of the week, you would have earned $3,000. The idea is that literally within approximately 12 weeks, a little over 3 months, you would have hit $1 million. Very doable. There's a ton of fees in terms of Forex and withdrawals, so plan on that. And yes, this is based off of $10 per pip pairs. But you can see that it's easier to do with $1,000. But here's the thing, it's not impossible to do with a $200 account either. Obviously, your percentage that you're going for per week is going to be a little higher. So you can't go for like a 50, I'll just type this in to show you. If you went for 500 pips on this account and we had 5 or 6 trades kind of stacked, you couldn't do that lot size because you'll blow the account. So you guys know I kind of like my repeating weird numbers. You guys can plug and play and see based off of your previous weeks and your previous results how many pips you want to go for per week. That's totally up to you. Let's see, if you're stacking and your lot size says that you should be using a 0.13, What I typically do is I do my heavier lot size on my smallest take profit. This way it frees up my margin percentage, and it frees up my account. So if I had stacked 2 trades, for example, and one of them had a 30 pip take profit, I would do like a 0.07 on that trade, and I'd let that 0.06 ride out for the duration of that trade. So that's how personally I would do it. It kind of keeps my account safe. As you know, I'm very big on money management, so whenever you're in profit, you should always, always, always move your stop into profit. If you're not doing that, you're gambling. Yes, I know the market needs room to breathe, but if it retraces, you can get back in, but you can't unlose the money you just lost if it hits your stop loss. So that's my personal philosophy. Not everybody trades that way. I know some people who are highly successful and do not, they hate that idea. So it is up to you and how you see the charts. This spreadsheet will be in the super easy Google Drive, so you guys will have access to it. Brandon Holiday will kind of create me a Windows one for all of you non-cool people who don't like apples. This way you guys can access it, and if you have any other questions or comments, you guys can maybe jump on one of the live trading rooms. I apologize if I don't get back to you in Telegram, because it is very, very difficult to scroll through and find hundreds of messages. So if I didn't get your message, please just message me again, and hope your name will come to the top out of hundreds and hundreds of people, and then I'll at least know you messaged me. So if I don't get to you, just know I can't see you in that very, very long stream of messages. So having said that, same concept, this is your weekly goal. I will change that so it's not so confusing. As you can see, it's kind of programmed in where it will tell you what your growth was right here. And it's okay if you had weeks where you didn't hit your goal. You shouldn't really have a lot of weeks where you took an entire loss, because our system is very, very accurate if you're following the rules. It's incredibly accurate. So there shouldn't be any full week that you took a loss for the entire week. Like, you could have taken some losses on some trades that week, but in general, you shouldn't have an entire losing week where you are less than where you started. And if you are, we probably should talk and figure out what you're doing wrong. So yeah, but this will show you kind of what your percentage is. So it'll show you here. And then this one doesn't have the total balance, but it gives you a good idea. So there's your total balance. And that's it. So I hope this answers all your guys' questions. I will double check my editing to make sure it's all accurate to the best of my ability, and make sure that this is posted so you guys can have any. This should answer all of your questions. It's super easy. The whole idea is just compounding. That's all we're doing, is just compounding. Whatever. Let's do this. Here we go. The whole idea is just compounding. That's all we're really doing, is kind of compounding our account. We will take losses, and that's okay, provided that you're on the right track. So if you found a few good trades that day, stop trading. Don't keep looking for another trade. Know when to walk away. That's why I don't tell you guys to go for a daily goal, because a daily goal, at least for me, turned out to be pretty negative, because obviously some days you do so well that you surpass an entire week. The problem isn't the good days. The problem is the bad days where you didn't do well, and now you're looking and you're looking and you're looking, and then you revenge trade and you're making poor decisions based off of emotions and not out of intelligence and proper risk management. So I want to keep this super short. That's pretty much all I have, guys. I hope you have a fantastic Wednesday, and I will see you guys tonight on the call.